Hello, welcome once again. If you haven't subscribed to this YouTube channel, please do so as we post videos on accounting that would help you to understand all kinds of accounting, from financial accounting to management accounting. And this video will definitely help you. Today, we will be talking about IAS 40, which refers to investment property, or which treats investment property. Very, very key. It's a very, very core accounting standard that needs to be properly understood. Today we'll be laying the theoretical framework for IAS 40, and in subsequent videos we'll spice it up with some scenarios and some questions. So what is investment property, first of all? In our past videos, we've already talked about property, plant, and equipment, right? We've already talked about that. So what exactly is investment property? Investment property is basically a land or building that is held to earn rentals or for capital appreciation, or both. This is a property that you don't buy to live in yourself. It's not a residential property, but it's an investment property that you hold it to earn rentals or for capital appreciation, so that when you sell it at a profit and make money. So it's land or building held to earn rentals or for capital appreciation, or both, rather than for use by the entity or for sale in the ordinary course of business, right? If it's for sale in the ordinary course of business, that's the business that the entity is into, you wouldn't classify that as an investment property. But if it's a special property that is held for rentals or for capital appreciation, then that is certainly an investment property. When you hear ordinary course of business, it means that this is the normal business transaction that the entity involves itself in. So if the entity is into selling houses, that's what they do in the ordinary course of business. That's a separate situation. But here we are talking about a situation where an entity buys a house, right, or buy some investment property in order to earn some rentals or for capital appreciation. So this is not residential property. That's what we need to know. Number two, owner-occupied property is excluded from the definition of investment property. So owner-occupied property is the same as residential property, where, and this is more specific, owner-occupied. The owner occupies the property. It's excluded from the definition of investment property, because once you are not living in it, it's not an investment property. So their owner-occupied property is excluded from the definition of investment property. So these are properties not used by the entity in general operations. These could be spare properties rented out to third parties or specifically bought in order to profit from a gain in value. So you see, that's exactly what we were talking about. This is not properties used by the entity in their general operations, but these are it could be spare properties, right? A spare property somewhere that the entity decides to rent out to another party to make some money, or the entity can go into buying land or buying a house just to take advantage of rentals and capital appreciation. There could be a situation where a building can be accounted for in two different ways. If an entity occupies a premises but rents out certain floors to other companies, then the part occupied will be classified as property, plant, and equipment under IAS 16, with the floors rented out classified as investment property. Let me read that again. There could be a situation where a building can be accounted for in two different ways. If an entity occupies a premises but rents out certain floors, then the part occupied will be classified as PP&E, and the part rented out will be classified as investment property. So there's a situation where you take a huge building, right? And the owner of the building occupies some and rents some out. So the parts that the owner occupies will be treated by IAS 16, which we've talked about in our previous video. If you haven't watched it, please do so and watch it. And that will be treated by IAS 16. The parts that that is occupied by the owner will be treated by IAS 16, which is property, plant, and equipment. And the parts that the owner rents out will be treated by or be handled by IAS 40, which relates to investment property. I hope that makes clear sense. Yeah. So for example, if you have a building and the building has, let's say, 5 rooms and the owner occupies 2 and rents out 3, the 2 that the owner occupies is not investment property. And so those 2 would be classified as property, plant, and equipment per IAS 16. The 3 that the owner rents out will be classified as investment property per IAS 40. Very, very important. Now let's look at the accounting treatment. Investment property should initially be measured at cost. IAS 40 then gives a choice for subsequent measurements between the following. So initial measurements always at cost. This is quite similar to what we saw in IAS 16. When it comes to subsequent measurements, you have 2 options: the cost model and the fair value model. And once the model is chosen, it must be used for all investment properties. Under the cost model, the assets should be accounted for in line with the cost model laid out in IAS 16. We explained extensively what the cost model means, that is the cost of the assets, the cost of the assets. Under the fair value method, however, the asset is revalued. This is where revaluations come. The asset is revalued to fair value at the end of each year. Then the gain or loss is shown in the P&L. The gain or loss is shown in the P&L, not other comprehensive income. And no depreciation is charged on the assets. Fair value is normally established by reference to current prices on an active market for properties in the same location and condition. So you might be wondering, how do they do this fair value, or how do they revalue? They look into the markets and look at current prices for properties in the same location and in the same condition. That's how you come up with your fair value. So the asset is revalued to fair value at the end of each year, and the gain or loss is sent to P&L, not other comprehensive income. If you haven't watched IAS 16, please do so to give you an understanding of our background. That would help you to understand IAS 40 better. Now let's talk about the fair value model more. If an asset is transferred from property, plant, and equipment to investment property, so we are by property, plant, and equipment, we are talking about owner-occupied property to investment property, and the fair value model for the investment property is used. The asset must be first revalued, per IAS 16, which we talked about. That will create a revaluation surplus in equity and then transferred into investment property at the fair value. So if an asset is transferred from owner-occupied to investment, then the asset has to be revalued and then transferred into investment property at fair value. Very, very key. If the cost model is used for investment property, the asset is transferred into investment properties at the current carrying amount. It's transferred at the current carrying amount. If you are using the fair value method, it is transferred into investment property at fair value. Very, very key. If an asset is transferred from investment property to owner-occupied or property, plant, and equipment, and the fair value model for the investment property is used, you revalue the property first. You have to revalue the property first, per IAS 40, per IAS 40, and then transfer to property, plant, and equipment at fair value. So this is the opposite of what we talked about initially. If the asset is transferred from investment property to property, plant, and equipment, or to an owner-occupied property, and the fair value method is used, then we revalue the property, the IAS 40, and then transfer to property, plant, and equipment at fair value. We said that if the assets, in the first point, we said that if the asset is transferred from property, plant, and equipment to investment property, then the asset must be revalued per IAS 16 and then transferred into investment property at fair value. So here is the opposite. We are transferring from property, plant, and equipment. We are transferring from the investment property to property, plant, and equipment. So same principles and same procedure. If the cost model is used for investment property, the asset is transferred into property, plant, and equipment at the carrying amount. The carrying amount. So always remember this. For fair value method, the transfer is at fair value. For the cost model method, the transfer is done at the current carrying amount. So this is a theoretical background to IAS 40. I hope this lecture was very, very helpful. Thank you. Subscribe to this channel if you haven't. And if you have any questions on this video, kindly leave it in the comment section and we will definitely respond to it. Thank you and have a good day.